Micron is no longer just a memory chip company riding semiconductor demand. This is now one of the clearest AI infrastructure boom stories in the market. Revenue is exploding, margins are surging, and Wall Street is treating Micron like a long-term AI winner. But there is one major problem. This business is still deeply cyclical. The entire stock thesis depends on investors believing that this AI-driven pricing boom is not just another temporary semiconductor peak. That is exactly where the risk begins. Micron is going through a near-violent earnings expansion. After a brutal 2023 downturn, revenue rebounded sharply, then accelerated as AI infrastructure demand pushed HBM and DRAM pricing much higher. Gross margins and operating profitability improved dramatically because Micron has a huge fixed-cost manufacturing base, so rising prices create massive operating leverage. Cash flow is recovering hard as pricing strength improves profitability and manufacturing efficiency. What changed is simple. AI data center demand created tight supply in memory markets. Why it matters is even simpler. Micron is no longer being valued like a slow cyclical chip maker, but like an AI growth engine. That is a very different market expectation. This stock does not look cheap if you believe Micron remains a normal memory business. Morningstar's fair value estimate sits at $455, while the stock traded around $724, implying the market is pricing in stronger durability than analysts assume. Current valuation only makes sense if AI-driven HBM demand stays elevated longer. Pricing remains unusually strong, and Micron avoids a severe memory down cycle. The core business, DRAM and NAND, is still commodity-like and historically cyclical. The future expectation, however, is that HBM and AI demand can partially reshape profitability. Investors are paying for a stronger future, not the old Micron. If that future softens, this multiple compresses fast. Micron is becoming an AI memory infrastructure supplier, not just a traditional memory manufacturer. HBM is the strategic center because it feeds AI accelerators and high-performance computing demand. That is logical because AI workloads need more memory bandwidth and capacity. But it is still risky because Micron is not building a software moat or platform ecosystem. It is still selling memory, just more advanced memory. That means the company is upgrading its product mix, not escaping the underlying commodity cycle. Strategy-wise, this is smart. Structurally, it is not a full business transformation. Micron is fighting in one of the toughest semiconductor battlegrounds. Its biggest rivals are Samsung and SK Hynix, especially in DRAM and HBM. Micron is strong because it has scale, vertical integration, and growing HBM relevance. It benefits from AI demand and has become more competitive in premium memory segments. But where it is weaker is durability. Samsung has enormous scale and diversification. SK Hynix is a major HBM force and deeply tied to AI supply chains. Micron is strong enough to compete, but not dominant enough to control pricing or reshape the industry. That matters because pricing power remains fragile. The biggest risk is that investors mistake a pricing boom for structural change. If memory supply expands too fast, pricing collapses. If AI infrastructure spending slows, HBM demand cools. If China restrictions worsen, revenue pressure increases. Micron also carries heavy fixed manufacturing costs, which means weak utilization can crush margins quickly. Because DRAM and NAND are still largely commodity businesses, the thesis breaks if AI cannot create more durable profitability than previous cycles. If Micron turns out to be just another memory peak story, today's valuation becomes very hard to defend. The upside is real if Micron becomes a larger long-term AI memory winner instead of just a short-cycle beneficiary. That means HBM keeps gaining share of revenue. AI data center demand remains strong for years. Supply stays disciplined, and margins stabilize above historical mid-cycle levels. Success would look like Micron proving that AI can permanently lift earnings quality, free cash flow, and investor confidence. If that happens, this becomes less of a boom-bust chip stock and more of a premium AI infrastructure business. That is the bull case. Micron is not a safe-value semiconductor stock anymore. This is a high-expectation AI cycle stock with real upside and very real downside. It is for investors who understand semiconductor cycles, can tolerate volatility, and believe AI demand can stay stronger for longer than history suggests. The reward can be significant if Micron proves this cycle is different. But if pricing normalizes like it usually does, the market may remember that memory businesses can rise fast and fall even faster. Micron is powerful, but this stock only works if the AI boom lasts longer than the cycle. I'll break down the next one soon. Subscribe if you want to stay ahead.